We've had 2008 financial crisis, we've had COVID, and my portfolio grew through that entire period.
That's Matthew Brockman. He's a managing partner and the chair of the investment committee at HG, the largest tech and software investor in Europe.
We invest in application software companies that sell to medium-sized enterprises and SMEs. And these are incredibly resilient companies.
Today on the show, I'll ask Matthew how sector specialization has helped his team prepare for volatile times.
It's boring on the growth side and the upside, predictable, but it's also nice and stable and boring on the downside.
I'm Hugh MacArthur, head of Bain's global private equity practice, and this is Dry Powder. Matthew, welcome to the show. Really appreciate you joining us today for this conversation.
Pleasure to be on. Thank you for having me on here.
Let's start with what's going on in the equity markets now writ large. We've had a lot of volatility over the summer. There was a correction, then a bounce back. What was your initial reaction to the public market sell-off in Europe and the US, especially in the tech sector?
I think we were all surprised, Hugh, when we saw the speed with which the market changed, right? We'd had 10 or 12 years of benign growth, and then suddenly this very sharp change in sentiment. And I think it reminded me of two things, really. One is the speed with which the public markets change. So the public market sentiment and the willingness of people to sell stocks to gain liquidity, just how rapidly that moves through and how much volatility that creates. The second thing is it reminded me, which is there's so many people in our industry who've not seen a real downturn, right? They've had 10 or 12 years of a very benign environment. And it's only really us old lags who lived through the dot-com and lived through 2008 who have some pattern of recognition about how these kind of market shifts can happen and how quickly they move.
I mean, there's this interesting thing, Matthew, about how this just doesn't feel like 08, 09 to me. Maybe it will in 6 months, but it doesn't really feel like we're in that kind of a situation where it's all cash on the balance sheet, all hands on deck, 20% out, cost out, to show me your 25% down revenue scenario for next year. I could be completely wrong, but it just doesn't quite feel that way because there are so many mixed factors going on in the macroeconomy. How do you think about that compared to what you went through in the Great Recession or in the dot-com bubble of 01?
Well, let me pick up the theme that we went through in 2020, right? So we had COVID, we did draw revolvers, we protected balance sheet, we stockpiled cash, we tracked every company by the week, we had all our CEOs on Hangouts every Thursday night. We did all of that work in sort of April, May, June. And it didn't make any difference, is the honest answer, because our trading slowed down a little bit and we had one or two companies that sell software on a kind of transaction basis. But actually the effect was so limited that it was a good exercise to go through. It was almost like a drill, but we didn't actually need to deliver on it. And so I hope that doesn't make us complacent now in 2022, because we're going to go through a different type of reset, a different type of economic environment. But the resilience of the portfolio in a completely unexpected, non-travel, lockdown environment was a sort of real illustration, I guess, of robustness from really being at the coalface of making those decisions.
I understand that HG actually breaks the tech sector, or the software sector, I should say, into different segments so that you can actually invest with confidence in those subsectors. How do you actually do that?
I would say the first thing we do is we look at mature companies which typically sell a business application, paying my taxes, filing my accounts, selling insurance. And so that really defines a set of the technology market, which is arguably lower growth. Our businesses are typically growing high single digit, double digit organic. I mean, all of our businesses have got, thousands of customers, have got mature products, have had probably 10, 20, 30 years of IP built into their software products. They are fundamentally cash generative, fundamentally profitable. So we're in the slightly boring end, dare I say it, of software and technology. It's boring on the growth side and the upside, predictable, but it's nice and stable and boring on the downside.
How is HG actually re-examining its own portfolio in light of the recent bounciness or choppiness in the equity markets this summer?
We're not battening down the hatches. We are, I guess, deliberate and fortunate. So we invest in application software companies that sell to medium-sized enterprises and SMEs. And these are incredibly resilient companies. It's not that we're completely immune from any kind of macro. You will see a slowdown in kind of demand for the products. You will see some buying decisions get deferred. But we don't drop revenue, we drop growth. We do protect balance sheet, we do protect the business, but we don't have that same incredible volatility that we might have if we had retail businesses or travel businesses or businesses that had a more transactional business model.
Now, if we think about the potential, Matthew, for a downturn in the future, you mentioned applications like doing your taxes. You have to do your taxes whether there's a downturn or not. Are there certain subsectors that you like to invest in that can not only survive, but actually flourish in a downturn situation?
I mean, what you say, Hugh, is correct, which is most of what we're trying to do here is very resilient application. So it is, it's stuff you have to do. It's regulatory driven, not discretionary. And you get the acid test of that in a downturn in 2008, with COVID, in lockdowns. And that's when we've been able to test our portfolio at its most extreme. And we can see the evidence of that. What I think you will see this time around is we're in that sort of probably slightly unusual dynamic of a recession, very high raising interest rates, but very low labor availability, right? We've got very high pressure on wages. And so I think we will see this cycle around almost an acceleration of adoption of software as people are thinking about how do I get more automation? How do I get more workflow processed basically by machine, by cloud computing, by software, and trying to substitute for high cost labor and frankly, just complete labor shortage in a bunch of these markets.
That's a terrific insight because automation is one way to tackle the wage pressure and frankly, just the pressure of finding people to do the work. We're finding that there are twice as many jobs available in the US right now as there are people looking for jobs. And so there's the automation benefit of actually just getting the job done, number one, and then getting it done in an economically efficient way, number two.
Yeah, I was talking to somebody the other day who'd been traveling in the Far East, and they'd been in a restaurant and they've been served entirely by an automated waiter system, an actual robot coming out and bringing you your food and bringing you table service. And okay, that's an extreme example. But when you think about what that could look like in 10 or 15 years' time, if you think about what's going on in vehicles and transportation, and that's all around technology, product automation. And I think that's going to accelerate in this environment. When you're coming off of COVID, when people are making lifestyle decisions, there's less people in the workforce, less immigration in a bunch of these countries, more pressure on wages. People are going to have to think about how do I get more of this workflow done, this kind of professional workflow done by automation and technology.
That's astonishing. I'm sure your colleague was probably glad that the robot wasn't doing the cooking, or at least I hope the robot wasn't doing the cooking. One thing we don't need to talk about, Matthew, but I'm interested because I have talked to a couple of other software GPs about inflation, and they've described to me that they see inflation and they see margin compression in a couple of places. And unfortunately, they're the two biggest expenses that a software company typically has. One is I have to pay the software engineers more to actually build the product or service that I'm providing. The second is to acquire the customers, I now need to pay a lot more than I thought I was going to in order to get that same level of growth. And that's compressing my margins in certain software businesses. Are you seeing that at all, or have you developed a pricing playbook that allows you to recapture any margin pressure?
It's an absolute trend. So we were looking at the start of the year about how much pressure we would see on labor rates and how fast they would grow. And most businesses were budgeting a kind of 3 or 4% growth in labor cost, and it's higher. And you are facing the pressure of just available developers in terms of your ability to fulfill products. And, our businesses are 70% labor cost in terms of how they operate. What we have done for, I would say, at least 6-9 months now is think about pricing playbook, which is how do you think about packaging of products, customer usage, and then essentially how are you going to be ahead of the curve in terms of resetting expectations of price changes. And if you actually wind it back, if you look at some of the public companies, and Microsoft started doing this at the end of 2021, most of their prices were up 10 or 15% at that point. And so you're seeing this come through the industry, but we had to really go and change, almost try and drive a change in perception from our portfolio to think that, 3 or 5% price increase, that wasn't strong enough, right? That wasn't a result. In fact, that was a margin compression problem.
That's certainly been our experience at Bain as well, Matthew. In fact, and what we found, and I'm sure you found this with your portfolio companies as well, is that transparency and communication with the customers is absolutely critical when you're taking these really unprecedented type of pricing increases, because the industry's never really had to deal with any substantial inflation in its entire history. I mean, the private equity industry really hasn't dealt with it. So it's kind of a new muscle that you've had to develop along the way.
I completely agree. I mean, one of the biggest challenges we had this year was getting that behavioral shift through the businesses. People were expecting that 3 or 4% was a good result in terms of price increases. And people are trying to grow, right? They're trying to sell more software every year. They're trying to keep the customers happy. If you say to them, you need to go and get an 8 or 9%, increase, and there's some packaging things you can do and so on and so on, but it needs to be 8 or 9%, people think they're going to lose customers and they think that growth is going to slow. And that's not the case, but it's a very different philosophical way of operating the business versus the last, well, I guess probably 20 years for most of us, since we saw real inflation as being a substantial problem for us.
That makes a lot of sense, Matthew. Talking a little bit about the valuations and multiples in the market right now. And valuations have been all over the place in the public sectors, and people are wondering, well, what does this mean? And what does this mean for the private sector? Is the private sector now disconnected from the public sector? Is it going to follow? What is your outlook on the tech sector's valuations right now and the kinds of multiples that you're seeing to both buy and sell assets?
So I think it's really important to separate between high growth, non-profitable companies and profitable companies. And as we talked about a little bit before, with the high growth, non-profitable, you saw a real spike in valuations in sort of the middle of 20, right? These businesses used to trade at 6 or 7 times revenue on average. And that really leapt from sort of the middle of 20 when an awful lot of that stimulus came into the market that followed years of quantitative easing. And then that stimulus came back out, right? As we came back through the current period, revenue multiples of 6 or 7 times went to 12 times, and then they're back at 3 times. Revenue multiples of 20 times we saw at .com. So we were still below kind of where the .com absolute peak was, but nevertheless, you saw this sort of elevated sort of effect. In the slightly more sort of predictable, profitable side of the business, you saw some lift, right? If I take revenue multiples again, 5x was kind of where we were coming into 20, it hit 7x, it's now back at 5. So we're back to where we were before the kind of really heavy stimulus period of kind of the middle 2021. And I think that's back to normal, right? That to me feels like a normal plateau, if you're thinking about a high quality software company, decent recurring revenue, decent margin structure, all the characteristics you'd like of a good company, we're back in a zone where that feels like a sensible sort of market price. And I'd argue that's what we're seeing, frankly, in both what we see, particularly in the private markets. Businesses are trading at those kind of levels.
So if there is a downturn in the future, Matthew, is that going to offer, in your view, more relief in terms of lower multiples, or will competition and selectivity actually keep the multiples where they are now?
I think if I segregate you between kind of buyouts and software buyouts, I can imagine the buyout market, if you're facing consumer businesses, retail businesses, manufacturing businesses, now is a time to think about when you might be able to deploy more capital more aggressively. You're probably coming into a period where that's more attractive. I suspect that's not going to be a particularly pronounced effect in what we do. The predictability of these businesses, the adoption pattern we talked about, the opportunity set to find growth in a macro environment where there's very little growth. And most of these businesses have got, tailwinds of adoption, automation, processing power. There's tailwinds behind these companies. I don't think we'll see a re-rating of our sector, particularly from where we are now.
I think I know what you're going to tell me here, Matthew, but I have to ask, are you reconsidering at all your long-term investment strategy in the event of a downturn in the next several months? Or does recession really just not change what you're doing?
So we've had this investment strategy for 20 years. And so far it's worked well, right? And our ambition is to continue that. So really it is using what we've done for the last 20 years for the next 20 years as we think about how does software get used for more activity in the commercial environment. It's hard to explain in real boom times why you need to really stick to your core when you've got a bunch of really smart people who join your business who've only ever known things sort of go up to the right, and trying to explain to the team why we're disciplined and why we focus when people are setting up growth funds and they're doing this thing over here and now they're going to innovate over here and they're going to go into horizontal software and dev cap, and explain to them why we're going to stick with application software that's got sensible levels of growth, which is a bit more predictable. And people are desperately trying to change the model or change the kind of focus. And at times like this, now you find out why. Right? This is the once every 10-year event where you say, actually, I'm sitting on a portfolio which I would be very disappointed if we didn't grow materially this year, even though, the macroeconomic environment is going to be tough. So now is when you find out resilience and just how disciplined you've been and how cautious you've been and thoughtful you've been. So it's not that we're not trying to be entrepreneurial and challenge ourselves to grow faster and do more, but we're doing it in a disciplined way. And that's really at the core of why I think you can sleep at night in 2022.
That's a great answer. And I think a lot of those disciplines and a lot of that sector expertise was developed because of the experience in 2008 and 2009 when the industry was not nearly as well prepared to weather a downturn like this. So I think a lot of the disciplines that you're talking about, Matthew, were developed by people like you who've seen the movies from 10 and 20 years ago and had to survive them, that it's not all growth and up and to the right, as you said, forever. It's we need to actually be disciplined enough to make sure that we can get through these once every decade events and still make the kinds of returns that all of our stakeholders are expecting.
Yeah, absolutely right. Absolutely right.
On the next episode of Dry Powder, I'll ask Matthew what longer term trends are going to transform the way we work in the future.
We're still implementing SaaS, and it's still right in the early stages.
I'm Hugh MacArthur. Thank you for listening.